my hand, I have a Capital One Visa credit card. Every time I use this card in a business to pay for something, there are three people that charge a fee to that business to pay for that transaction. First is Capital One, because they issued me the card. Number two is Visa, the card brand that works with Capital One. And then the last one is the credit card processor. For 99.99% of merchants out there, the fees that Capital One and Visa charge are pretty much non-negotiable, right? There are exceptions to the rule, but in most cases, those companies, the banks and the card brands, make their set amount of money on each transaction, and that's how they earn revenue for their business. The payment processor facilitates the transaction between the issuing bank, the card brand, the merchant, and the cardholder, and they charge a fee in the form of a percentage, a transaction fee, a monthly fee, whatever they need to do in order to generate a profit to process the payments for those businesses and successfully serve them. Now, let's look at a company like Square, Stripe, or PayPal. Those companies don't do normal pricing. What they do is they charge a flat fee of, let's use Stripe, for example, 2.9% plus 30 cents per transaction. And what they do is they bill the merchant that flat fee on every transaction. They pay these fees to the banks and the card brands on the back end, and then they keep what's left over. Typically, for most businesses, it's a good general rule of thumb that the banks and the card brands collectively bring home about 2% of what you process. So if you pay 3% out the door, which many merchants do, that's pretty standard, the cost that the banks and the card brands earn is 2%, and the processor earns the remaining 1%. That's how the processor generates revenue, that's how they grow their business, and that's how they essentially earn money from doing their job. Now, I can take it a step further, because if you're a merchant that uses Stripe, Square, PayPal, and you have flat rate pricing, usually that's a good thing. If you're a bigger business or a brick and mortar business that does a ton of volume, you should be on a pricing structure that's called Interchange Plus. Interchange is the fee that's charged by Capital One or any other issuing banks, and the card brand fees are lumped into that as well. Now, if you on Interchange Plus, it's a very transparent pricing structure because there's different rates that the banks and the card brands charge for differences, like, for example, if it's a credit card or a debit card, right? Debit cards are way less expensive to accept because there's less risk on the bank's behalf. And also, there's usually not points, perks, or miles that are earned by the cardholder on those transactions. As a business owner, you're going to get a mix of credit cards, debit cards, prepaid cards, and other types of cards that all carry their own classification and their set rates. Typically, you can expect 2% out the door to go to the banks and the card brands, and then the processor will charge a transaction fee, a percentage of sales, a monthly fee, as I mentioned, and you add those three fees up, and that's how you get to your out the door percentage. Here are some factors and things that allow for interchange to fluctuate, right? The most significant factors that will determine your interchange fees are your average ticket, your business type, and how you take credit cards, right? The business type, there are some businesses like supermarkets that receive a massive discount from the card brands and the banks simply because they do a lot of volume usually, and they provide something that's essential for human survival. If you're running a business where you're taking payments at a retail shop, typically you're going to pay somewhere between 2 and 3.5%. In fact, that goes for most merchants. You're going to most 95% of our clients fall somewhere between 2 and 3.5%. As a merchant that takes credit cards, what you want to know and understand, and really what you should pay attention to, is what did you pay to process what you sold? Now, if you're a business that does $100,000 in sales in a given month and your fees to take credit cards out the door were $3,000, your effective rate is 3%. That could be very competitive. It also could be very high. You know, if you're a restaurant doing that kind of volume and you're paying 3%, depending on your average ticket, maybe it's a low average ticket or a high average ticket, it really doesn't matter. You may or may not be overpaying. Now, if you're a business that's a high risk business that takes payments 3% on 100 grand, that could be a really good deal. Ultimately, what you care about as a merchant is to make sure that your effective rate stays consistent and that you're fairly priced with no surprises or no increases or any sort of hidden fees. My company, Rate Tracker, we take pride in the fact that we do not do rate increases on the payment processing fees, right? That's how we earn revenue. That's how we build our business. And our commitment to you is that when we set pricing and we offer you pricing on Interchange Plus, where you're paying your own fees, we're never going to increase our margin. I hope this video was helpful so that you can understand how credit card fees work. If you have more questions, I suggest reaching back out to the person that sent you this video so you can continue your conversation. Thank you.